Have you ever looked at a chart like this and watched a perfect trade turn into a total disaster? You thought you had the momentum, then bam, the market flips. Why? Because you were trading blind. You were ignoring the language of the whales. Most traders drown themselves in 50 complex patterns, trying to memorize shapes and still missing the entire point. The psychology behind the move. That's stupidly complicated. We're cutting the noise. I'm only giving you 8 game-changing patterns, the ones the smart money is actually watching. When you master these, you stop guessing and start reading the market like an X-ray. If this knowledge saves you even one losing trade, smash that like button right now. Let's get straight to it. What are chart patterns? Think of them as the market's secret roadmap. A chart pattern is just a visual representation of the ongoing battle between buyers and sellers. When you see these shapes, you stop guessing and start knowing the market's intent. Get this right, and you instantly improve your entry and exit timing. You learn the overall market psychology and trade with less emotion. This is the game changer. Now, chart patterns fall into 3 major categories. If you stop and think about their names for a second, they tell you everything you need to know. Reversal. Signals. The current trend is exhausted and about to flip directions. Continuation. Signals the market is just taking a breather before continuing the original trend. Bilateral. Signals the market is indecisive. It could break either way. Wait for the breakout. Let's start with 3 of the most powerful reversal patterns, beginning with the double top. If you see a clear M shape on your chart, you are looking at a double top pattern. The psychology behind this is stupidly simple. The price was in a strong uptrend, but when it hit the first high, the whales, the smart money, showed resistance. They said, "No more." The price drops slightly, but the buyers step in again to support the price. They try to push it to a new high, but they fail. They hit the same invisible ceiling. The second peak is the final failed attempt. As the price falls below the support level, what we call the neckline, the sellers put on so much pressure that the trend reverses. The battle is over. How to trade this? Don't rush. You need confirmation. You'll see trade volume high at the first peak, then it dips at the second peak. That's the key signal. Wait for the candle to break and close below the neckline. That breakdown confirms the sellers have officially taken over. Once the neckline is broken, that is your entry point for a sell position. Next up is the double bottom. The double bottom is the exact opposite. It's the market forming a clear W shape. This typically appears when a market has been in a sustained downtrend. Here's the battle. Sellers are in full control, pushing the price down to a new low. But at that low point, the buyers step in, buying the dip. This builds a strong support level. The price bounces. Sellers don't give up easily. They try to break that same support again, but they fail. The buyers defend the line. This second bounce is the first sign the selling pressure is weakening. Once the price pushes up and breaks above the neckline, it confirms that buyers have officially regained control. Boom. Bullish reversal confirmed. How to trade this? Never guess the reversal at the second dip. That's where the impulsive traders get trapped. You need the breakout to confirm the buyers have taken full charge. You can even wait for the price to retest the neckline, which gives you a safer, cleaner entry. Another reversal pattern is head and shoulders. This pattern is a classic for a reason. It shows up when the market hits a resistance level it just can't sustain. It's a bearish reversal pattern that looks like one high central peak, the head, and 2 lower peaks on each side, the shoulders. The psychology is similar to the double top, but more dramatic. Buyers manage to push the price to a new high, the head, but they fail to sustain that momentum. That failed attempt at making a new high is the market screaming that the bullish run is running out of steam. The price ultimately breaks below the neckline, the support line connecting the 2 shoulders. That final breakdown confirms the sellers have fully taken control. Now, flip that whole pattern upside down, and you get the inverted head and shoulders. This appears during a downtrend. The neckline acts as resistance. The buyers gain strength on the third bottom, and when the price breaks through the resistance neckline, it signals a massive reversal to the upside. How to trade this? Wait for that neckline to break out. You'll notice volume typically drops while the pattern forms, then it surges once the breakout happens. That volume surge is your confirmation. As I've said earlier, not all patterns signal reversals. Some just tell you the trend is taking a quick coffee break before continuing. That's where the flag comes in. A flag is a continuation pattern that starts with an aggressive price move called the flagpole. This sharp move shows one side is dominating. After that, the market naturally pauses. Traders take profits, and the price moves sideways in a tight channel that looks like a flag attached to a pole. When the price eventually breaks out of this tight channel and continues in the original direction, the pattern is confirmed. With the bullish flag, the price surges upward, the flagpole. Then it drifts sideways because neither side is trying to take full control. Once buyers step in again and break the upper line of the flag, it signals continuation of the uptrend. That breakout is your ideal entry. And the bearish flag is when sellers are in control from the start. Steep drop. The price makes a small upward correction as sellers take a quick pause. Buyers lack the strength to reverse the trend. When the price breaks the lower line of the flag, sellers regain control and the downtrend continues. That breakdown is your entry signal. You can place your stop loss just below or above the flag. That's your capital protection shield. Another continuation pattern is the ascending triangle. An ascending triangle forms when buyers continually push the price to create higher lows, which forms the rising support line. Meanwhile, sellers continue to defend the same price level at the top, creating a flat horizontal resistance. And this is a bullish setup. The pressure is building. The buyers are getting stronger while the sellers refuse to budge at the ceiling. It's a classic squeeze. Once the price finally breaks above that flat resistance, the uptrend continues, confirming a bullish breakout. How to trade this? Place your stop loss just below the lower trend line. Your profit target is the same distance away as the back of the triangle. Stupidly simple. The descending triangle is bearish and the exact opposite. It forms when a horizontal set of lows support meets a descending set of highs resistance. This pattern appears after a downtrend and shows sellers are gaining strength. They are pushing the price lower and lower, while buyers are trying to defend a flat support line. This usually tells you the market is likely to break out lower through the support level. Pro tip: if the market breaks out through resistance instead, it may signal the beginning of a new uptrend. Be ready to flip the script. Unlike the triangles we just learned, the symmetrical triangle is the ultimate sign of market indecision. A symmetrical triangle is formed when both buyers and sellers put equal pressure on the market. Buyers raise the price from lower levels, while sellers push it down from higher levels. This results in two converging lines that form a perfect triangle. Here's the tricky part. This is a bilateral pattern, meaning it doesn't give you a clear direction. How to trade this? You wait. If the price breaks above the upper line with strong volume, buyers take control. If it drops below the lower line, sellers dominate. Wait for a clear breakout before risking any money. Don't guess. The last one on my list is the wedge. It's the most common and effective pattern out there. A wedge is also a bilateral pattern. It can either continue the existing trend or initiate a reversal. At first glance, a wedge might look like a flag, but instead of parallel lines, the trend lines in a wedge squeeze closer together. This shows that both buyers and sellers are fighting for the final word. During a wedge, you'll also notice a decline in trading volume. The market is holding its breath, preparing for a breakout. Rising wedge. This slopes upward, but the price keeps tightening. This shows buyers are losing strength. Eventually, the price breaks below the lower trend line, which starts a bearish move. Falling wedge. This slopes downward. When the price breaks above the upper trend line, it typically triggers a bullish reversal. Wedges are easy to spot but tricky to trade, so practice spotting them on charts before risking real money. Get good at this, and you'll see the market in a whole new light. So, there you have it. You now have the secret sauce. The 8 critical patterns that determine which way the market is going to break. Remember this, trading isn't about luck. It's about spotting the battle lines before anyone else. Every time you see a double top or a falling wedge, you're looking at a live battle between the buyers and sellers. You now know who is winning. Go take this knowledge, use your demo account, and prove this system to yourself. Stop trading blind. Start trading smart. Thank you for watching, and I'll see you guys next time.